1792, the Buttonwood Agreement and the birth of the NYSE. For centuries, the wealth and power of states and empires were measured by the lands they controlled, their gold reserves, and the trade routes they secured. But by the late 18th century, a new factor began to determine economic power. Wealth was no longer only the gold stored in treasuries, investments represented on paper also started to shape the economic future. The story of today's modern capital markets began with that shift. On May 17, 1792, 24 men signed a short agreement in the shade of a large sycamore tree on Wall Street in New York. At first glance, this modest document, made up of only a few sentences, might have looked like an ordinary commercial contract. But history would regard this small agreement as one of the most important milestones in the development of the financial world. This modest document was the Buttonwood Agreement. To understand why this agreement carried such weight in finance, we must first look at the economic picture that formed after the American War of Independence. The war ended in 1783 and the sovereignty of the United States was officially recognized. But political independence did not automatically mean economic order. The newly independent country faced the ruins left by war. Both state governments and the federal government were in serious financial difficulty, and investor confidence in the government was very low. To enable economic growth, the government first needed to build a reliable financial system. In 1790, Treasury Secretary Alexander Hamilton prepared a comprehensive fiscal reform program to revive the economy. Restructuring government debts, increasing national creditworthiness, and making public bonds reliable investment instruments formed the foundation of this reform. Hamilton had noticed an important fact. A country's economic strength depended not only on its ability to produce, but also on investors' trust in its financial system. As government bonds and the stocks of newly established banks began to trade in the market, the number of investors increased rapidly. But this growing market faced a serious problem. There was no regularly operating institutional exchange. Trading took place in coffee houses, inns, street corners, and open spaces. Each broker set prices as they saw fit, and investors often could not learn the true market value. This environment encouraged speculation and created risks of manipulation and fraud. There were no shared rules or standards, and more importantly, there was a lack of trust in the market. In such an environment, 24 brokers came together and decided to conduct their profession under certain rules. The essence of the two-article Buttonwood Agreement they signed on May 17, 1792 was simple and clear. First, according to the agreement, the parties would conduct securities transactions primarily among themselves, and independent auctioneers would not be given priority. Second, they would not lower their commission rate below 0.25%. Although composed of only 2 clauses, these decisions produced significant consequences in financial history. Thus, destructive price competition among brokers was limited. More importantly, a more qualified trading network that investors could trust was created. The Buttonwood Agreement became one of the earliest and most successful examples of market self-regulation in American financial history. One historical detail should be emphasized here. Contrary to common belief, the Buttonwood Agreement did not directly create the New York Stock Exchange, the NYSE, as we know it today. The agreement merely laid the groundwork for a collective community of brokers. For about 25 years those brokers continued to develop their activities, and finally in 1817 the New York Stock and Exchange Board was established with official rules. This institution would eventually become the New York Stock Exchange, NYSE, and grow into one of the world's largest capital markets. Therefore, the true importance of the Buttonwood Agreement lies not in founding a physical building but in establishing the foundations of an institutional market culture. Because financial markets are not just buyers and sellers. What keeps them standing is trust, and what provides that trust are rules. And institutions are what give life to rules. The seed planted in 1792 held an important place in America's economic rise. In the 19th century, railways were built, factories were established, banks grew, and insurance companies developed. Thus the country became a massive economic power stretching from east to west, supported by confidence. The enormous capital needs of these great transformations were met by the developing securities markets. Over time, Wall Street ceased to be an ordinary street in New York and became the center of the global financial system. But history taught a truth. No matter how strong financial institutions become, they cannot completely escape crises. The Panic of 1837. The banking crisis of 1907. The Great Depression of 1929. The 2008 global financial crisis. All these events repeatedly tested the foundations laid 2 centuries earlier. After each crisis, new regulations were implemented. New supervisory systems were created. Yet the fundamental question remained the same. How can financial markets be both free and trustworthy? That question continues to be debated. The search for its answer has been underway since that modest signing under a tree on Wall Street on May 17, 1792. Today, billions of dollars are traded on world exchanges every minute. Algorithms make trading decisions in seconds. High-frequency trading systems operate at speeds the human eye cannot follow. Technology has changed. Markets have grown. But one rule remains unchanged: trust lies at the core of finance. At the base of trust are strong rules. At the base of rules are strong institutions. History sometimes changes through great wars, sometimes through revolutions. And sometimes through a few lines signed in the shade of a tree. If you liked this video, don't forget to subscribe to the Stock Market Historian channel. Let's continue to discover the stories of how the stock market shaped world history together.